Hello and welcome to GCSE Business YouTube channel. Today we will be covering 1.3.2 Business Revenues, Costs and Profits. In this lesson we will learn the concept and calculation of revenue, fixed and variable costs, total cost, profit and loss, interest, break-even level of output, and we will understand margin of safety, and we'll understand the interpretation of break-even diagrams. So we will understand what break-even level of output is. We'll understand margin of safety, where margin of safety is within a break-even chart, and we will understand profit and loss areas within break-even diagrams, and then we'll understand the impact of changes in revenue and cost. So what is revenue, you might be thinking? Revenue is the amount of money that a company actually receives during a specific time period from sales of goods or services. So these include discounts and deductions for returned merchandise. It is the top line or gross income figure from which costs or expenses are subtracted to determine net income. So we'll understand net income a little bit later. I'll explain what net income is. The amount of revenue earned depends on two things. So that is the number of items sold and their selling price. So formula for revenue is revenue equals price times quantity. So let's look at an example. Total revenue raised by selling 1,000 items priced at £20 each is 1,000 times £20 equals to 20,000. So that's how we would calculate revenue. So let's understand what fixed cost is. A fixed cost is an expense that does not change as production volume increases or decreases within a relevant range. In other words, fixed costs are locked in place as long as operations stays within a certain size. So you might be thinking, since business, what are fixed costs? Well, your fixed costs are things like your rent, salaries, because if you're going to employ someone, you're going to give them a salary, and the salary is not going to change over the month. It's going to be a yearly salary or a weekly. So these are your fixed costs. Property taxes. So tax is another thing that's fixed. It might change each year in the April, but that is always the same for a specific period of time. Insurance, you normally get insurance for a year, so that will stay the same. Your utilities, this is the cost of electricity, gas, phones, and so forth. So these are your fixed costs. And now let's understand what variable costs are. So variable costs are basically the opposite of fixed costs, because a variable cost is a corporate expense that changes in proportion to production output. So variable costs increase or decrease depending on a company's production volume. They rise as production increases and they fall as production decreases. But the rent, for fixed costs, we cannot say, excuse me, this month I haven't made any sales, can I pay less rent? No, they're not going to let us do that. So that's why it's a fixed cost. But whereas variable costs change depending on how how much production a company has in a certain period of time. So for example, you might be thinking, so what are variable costs then? Well, the variable costs are things like raw material that goes into the product. So the more you produce, the more it will cost. So the more you'll have to buy from the suppliers. So the more you'll have to pay. But the less you use, the less you'll have to buy, and the less you'll have to pay the suppliers. And that is why it's variable. It's not the same as fixed cost. Production supplies, things like machinery oil, are consumed based on the amount of machinery usage. So these costs vary with production volume. So if you have lots of orders, you will need lots of machinery oil. But if you have a few orders, you're not going to need as much. So therefore, your variable cost will be up and down as depending on the volume of production. Commission is another variable cost. If salespeople are paid a commission only, salespeople are paid a commission only if they sell products or services. So this is clearly a variable cost. So if your business has some sort of commission where people have to sell a certain amount of items to make money, then so if 1 week all your salespeople sell loads of things, so your cost will be lots. But if in a week they don't sell that many products, then your sales cost will be down. So that's why it's a variable cost, whereas a salary is not a variable cost, because that is a fixed cost. That is over a year or a month. Whereas commission depends on how many they sell, then you pay them accordingly. For a salary, that doesn't work on the amount they sell. It's a fixed salary that you both agreed on. Another variable cost is shipping out. Some businesses a business incurs a shipping cost only when it sells and ships out a product. So if you have a shop and if you sell 10 items that have been ordered online, that will increase your variable cost, because you are going to get some stamps. You'll have to pay postage for these items to go to the customer. But if for a week if you don't have that many shipment costs, the variable cost is going to be down. Good stuff. I know you understand that very well, and that's why we're going to move on to total cost. In short, total cost is adding fixed, variable and overhead expenses associated with producing a good, including the cost of all the input factors used for producing a certain level of output. So that is your total cost. So total cost, you need to take everything into account, every factor that is involved in making a product. So formula for total costs is fixed cost, so that's your rent, insurance, utilities, everything, plus unit variable cost, so that's how much it's going to cost to create 1 unit times the amount that it's been sold. Yay, it's an advert time. As you know, there might be a couple of adverts in these videos, so don't get annoyed by them. That's how I can afford to upload more and more videos for them. If you don't like them, simply click skip. Okay, profit and loss. A profit and loss shows a company's revenue and expense over a particular period of time, typically either 1 month or a consolidated months over a year. These figures show whether your business has made a profit or a loss over that period of time. Profit and loss accounts show your total income and expenses, and it also shows whether your business has earned more income than it has spent on its running costs. If that is the case, then the business has made a profit. Profit and loss accounts are used to calculate both income tax and corporation tax. Failure to file either of these correctly can result in you paying added tax and penalties. So it is important that this report is right, and you as a new business starter get this right. So here I've got some good to know terms that you need to remember for your exam, because if the question is about one of these, you need to have a clear understanding of what each means. So net income means this is your income minus the cost of goods, expenses, and taxes. So that means everything is deducted and the final payment is income, or the final amount that is left over is net income. Gross profit, this is your total revenue or sales minus the cost of goods, of those goods sold. Operating profit, this is the profit you have after operating expenses like rent are deducted from gross profit. It doesn't include interest or tax deduction. Net profit, this is your actual profit. It's the amount you're left with after remaining working expenses are deducted from gross profit. So just be careful and cautious that net profit is not same as net income. They are two different things. Okay. Profit and loss calculation. So how would we calculate our net profit? So the first thing that we would do is we would deduct discount and allowance from your gross income, excluding VAT, to get your net income. Once we have our net income, we would then deduct the cost of sales from your net incomes to find your gross profit. Once we have our gross profit, we would deduct overheads from your gross profit to get your operating profit. When we have our operating profit, we would then deduct any other expenses from our operating profit plus any other income to find our profit before tax, and then we would deduct tax to reach our net profit or loss. So if we have taken all these steps and we have some money left, that means we have made a profit. But if we have taken everything out and we are minus, that means the figure shown is a negative figure. That means we have not made any profit and we are at loss. In any business that is in a negative figure, that's not good. So let's understand what interest is. A fee paid for the use of another party's money. To the borrower, it is the cost of renting money. To the lender, it's the income from lending it. So to the borrower, it's the rent, the cost for borrowing the money. For the lender, the person that's lending it, it's the extra money that they will get on top of the money that they are giving to you. So businesses have to pay interest to banks if they want to borrow money to expand, to buy new machinery, or to cover unexpected costs. So prices of a product go sky high and you don't have any money from anywhere. You can go from bank, get a loan, but of course there will be an interest on that loan for you to operate and keep on doing your business. So we can say that interest is the money you pay on top of the money, the amount you borrow, which compensates lenders for making their money available to you, as well as the risk they take, because they're not sure if you will be able to afford to pay them the money back. So that's a big risk they are taking. In return, they want some money for it, which is interest. If this system did not exist or was not allowed, there would be virtually no lending of money outside arrangements from between family members or close friends. If there were no lending, there would be considerably less economic activity. So in a way, interest is good. Now let's understand break-even level of output. So break-even output is a production level that achieves zero economic profit. In other words, a firm is just breaking even. The total revenue received by a firm at break-even output just matches the total cost incurred. However, because the total cost includes a normal profit, only economic profit is zero. A firm generally reports a positive accounting profit at the break-even level of production. To understand this further, we need to look at break-even charts. If you have not seen one before, then let's go ahead and look at one now. The next example I'll be showing you is from the BBC website, which I found really useful, and I'm going to use it for educational purpose. So the break-even point can be calculated by drawing a graph showing how fixed cost, variable cost, total cost, and total revenue change with the level of output. So here is how to work out the break-even point. So we'll be using an example of a firm manufacturing compact discs. So let's assume that the firm has the following costs: fixed cost of 10,000, variable cost of £2 per unit. We need to first construct a chart with output units on the horizontal. So we need to construct a chart with the output units on horizontal, and then we need to and cost and revenue on vertical y-axis. On this, plot a horizontal fixed cost. It is horizontal because fixed costs don't change with output. So as we have talked about it earlier, fixed costs do not change. So therefore that would be a straight line at how much our total fixed costs are. So this example, it is 10,000. And then we need to plot a variable cost line from this point, which will in effect be the total costs line. This is because the fixed cost added to the variable cost gives us the total costs, which is this line here. To calculate the variable costs, we need to multiply variable cost per unit times the number of units. In this example, you can assume that the variable cost per unit is £2, and there are 2,000 units, which is 4,000. That's how much it would make us. That's how much it would cost us to make 20 units. Now, plot the total revenue line. To do this, multiply sales price times number of units output. If the sales price is £6, so it costs us £2 to make, and if we are going to sell it at £6 and that we have 2,000 of them items were to be manufactured, the calculation would work out as £6 times 2,000, which is 12,000 total revenue. So these lines are, the blue one is our revenue, so it started from nothing. Fixed costs are this line here, which is a straight horizontal line. Our total costs are here because that's where our fixed costs are, and that's where our variable costs start from. Break-even point is here, where the total revenue line crosses the total costs line is the break-even point. So this is where we started with no money, so we had all our fixed costs and variable costs at 10,000, and as soon as we started the production, our variable costs started to increase, and so therefore we started to make more sales. And the point where our variable total costs, where our total cost crosses our revenue, that is our break-even point. So that means anything before that we were making losses, and anything after that we are making profit. So everything below this point is produced at a loss, and everything above this is produced at a profit. And that's basically all there is to break-even charts. So let's do a quick recap. Break-even point usually I can't even get the words out, usually means the business volume that balances total costs with total gains. At break-even volume, in other words, total cash inflows equal total cash outflows. Break-even, in other words, is net cash flow equals 0. Now, there's one more important thing that we need to learn, and that is margin of safety. In break-even analysis, the term margin of safety indicates the amount of sales that are above the break-even point. In other words, the margin of safety indicates the amount by which a company's sales could decrease before the company will have no profit. So let's assume that a company currently sells 3,000 units of its only product. The company has estimated that its break-even point is 2,800 units. Therefore, the company's margin of safety is 200 units. And the example that we looked at earlier, the margin of safety would be somewhere around here, because that's just after where they are making the profit. Formula for margin of safety expressed as a percentage. So to get a figure as a percentage of our margin of safety, we do margin of safety equals current sales level minus break-even point divided by current sales level times 100. This will give us a percentage at which we will be on our margin. It will be a percentage of our margin of safety. And that brings us to our last task in this lesson, and that is an activity that I would like you to do. I would like you to construct a break-even chart for a business of your choice. This break-even chart should show fixed cost, total cost, margin of safety, break-even point. It should show profit area, it should show loss area. You will need to come up with the fixed and variable costs for your selected business. Thank you very much for watching. Please make sure you like, share and subscribe to my channel for latest videos. Take care for now.